Well, let's focus on two important aspects in the banking sector, that is the non-funded loans and the risk-weight assets. Business entities require financing for a variety of reasons depending upon the nature of business. Non-funded loans are credit facilities in which the funds of a bank or a lender is not directly involved. There is no direct transfer of funds but paid by a lender to a third party on behalf of the borrower. The lender actually commits to a third party that it shall take care of the financial obligation of the borrower to the third party in case the borrower is unable to do so. So let's look at the types of non-funded loans. Number one, bank guarantees. As the name suggests, bank guarantees to discharge any liability to third party in the event of a failure by a customer to discharge their contractual obligation. Number two, letter of credit. Most commonly used by businesses engaged in export and import. It's a legal document issued by the bank to the creditor that guarantees the creditor shall receive the payment when certain conditions are met, even if the debtor is unable to pay. Third one, letter of comfort for availing the buyer's credit. Now, this is given to avail buyer's credit from overseas banks or FIS for procurement of goods or fixed assets. Hence, non-funded loans are risky in nature with no collateral in the event of a default from the borrower, and hence they also attract higher interest rate than secured products. So, let's take a look at it in detail for the banking sector. Highest non-funded loans as a percentage of total loans is for Indian Bank, IDBI Bank, IndusInd Bank and ICICI Bank as well. All of them have it above 15% of the overall loans. You won't believe, but Karnataka Bank has no non-funded loans, and for Equitas Small Finance Bank is just at rupees 5 crore of non-funded loans. The rise in share has been the highest for Indian Bank, Axis Bank, AU Small Finance Bank, while the decline in share of non-funded loans in total loans has been the highest for Yes Bank, IndusInd Bank, IDBI Bank, RBL Bank and ICICI Bank, all seeing a decline of anywhere between 3.5% to 17.7% share in decline to their total loans. Let's take a look at the non-funded book of lenders. The highest rise in non-funded loans over the last 3 years has been for Bandhan Bank, AU Small Finance Bank, Indian Bank, Axis Bank and CSB Bank. The highest decline in non-funded loans has been for Yes Bank, Equitas Small Finance Bank, very low base, Jammu and Kashmir Bank and RBL Bank. Now, how does RWA, that is risk-weight assets, gets impacted due to non-funded loans? Obviously, non-funded loans carry higher risk and hence higher requirement of capital. SBI is the only lender to see decline in risk-weight assets over the last 3 years. Highest increase in risk-weight assets when compared to loan growth has been for IDBI Bank, IndusInd Bank, Federal Bank, while RWA growth has been lower than that of loan growth is the best for Equitas Small Finance Bank, CSB Bank, Bank of Maharashtra, Canara Bank and Kotak Bank. So in conclusion, non-funded loans share has declined from 13.8% in Q1 FY21 to right now about 13.6% in Q1 FY24. They continue to remain elevated and hence give better NIMs to banks as well. Banking sector health is strong to absorb any shock. Yes, they are risky in nature in the event of default, but as they say, risk hai to ishq hai. All is well as the banking sector is strongly capitalized today against any shock.